Welcome to another episode of Equity Mates, a show where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are talking today all things private equity. Now, this has been, it's been an emerging asset class for decades now. Yeah. I think you could probably say it's truly emerged.
Yeah.
But it's also been an emerging area of interest for us as we go on this Equity Mates journey. You know, when we started 8 years ago now, we were very much interested in what we saw and what we sort of could associate with investing, which was the stock market. But as we learnt more about the stock market and the opportunities available there, we started to learn about this whole other world that was out there, the world of private money, of private assets, and private equity.
Yes, you're right, Ren. It's a huge opportunity. Now, if you've just joined Equity Mates for the very first time and have no idea what we are talking about here, simply private equity is where private money or investors go and buy private businesses or invest in private businesses.
Yeah, it's whether you're a public equity investor or a private equity investor, either way you're buying, you're becoming a part owner in a business and hoping that over time that business will get bigger and you will make money.
Yeah.
The difference, as our guest today explains, is that 1% of Australian businesses are listed on the stock market and 99% of them are private.
Yeah.
So the fish is, I was about to say the fish is a little bigger. The pond is a little bigger.
Pond's massive. Yes. Yeah. Plenty of opportunity. Now, to talk through that opportunity in more detail today, we are joined by Zac Midalia from Alceon. He's the managing director of private equity at Alceon Group. And they focus on the lower to mid market part of all of the private businesses that are out there, and we'll get into that in a bit more detail throughout this interview.
So there's a lot in this interview for everyone. For people who are interested in private equity, there's a lot where we unpack what's driven private equity's outperformance over the past couple of decades and what's driven Alceon's outperformance, how they invest. But we also touch on a number of key parts of investing that are relevant for everyone. However you invest, if you're like Bryce and I, who can't quite afford the private equity minimums, you know, what makes a great company, what they're looking for in an investment, what makes a great founder. I think finding great founder-led businesses is something that is universal across all investing. So there's plenty in here for everyone. But before we get into it, we want to say a massive thank you to Alceon for sponsoring this episode and helping us keep all of our content free across the Equity Mates network.
Well, with that said, let's jump into it. Zac, welcome to Equity Mates.
Thank you very much. Thanks for having me.
So, Zac, you started your career at MH Carnegie under Mark Carnegie, then worked at 3G Capital's Restaurant Brands International in the US and later at Melbourne's Kin Group. So plenty of broad experience there. How has that experience shaped your approach to PE today?
For me, I'm fortunate to come from a family on both sides, my wife and mine, and on both sides of my family of business builders and entrepreneurs. As I grew up, I was kind of force-fed business and, you know, I loved it. So every dinner table we were talking about different businesses. And so that really shaped my thinking about what makes a good business. And then as I went into my career, as you mentioned, I worked for Mark Carnegie, but I've had the opportunity to work for 3 Australian legendary investors who are all very different and really chiseled my style of investing. You mentioned Mark Carnegie. I also worked for Rafi Gaminder at Kin Group, and then Phil Green, who, you know, is in partnership with Trevor Lowenson and Morris Simons at Alceon, have each shaped really who I am as an investor and what we do at Alceon Private Equity. And then finally, as you mentioned, I worked for 3G Capital, which is a global corporation, you know, which is an investor operator, a very unique company, and they shaped, you know, how I think about building businesses for the long term. I worked for Mark for 5 years. It was in the early stage of my career. It was incredible 5 years. Mark has a very unique approach to being able to pull on everything from art, science, culture, philosophy into how he thinks about business. He actually comes at business through a philosophical perspective, and he's incredibly bright. And I think you guys have interviewed him before. But it's more than just his intelligence. It's actually his ability to bring so much into how he thinks about a business. That taught me a lot about actually thinking about the drivers of businesses. I mentioned Rafi at Kin Group. Rafi is one of the best people investors I've come across. He takes every meeting. And that's something that I've learned from him. And he has an intuitive mental model to picking winners in people. I've learned from that to build my mental model to what makes a great founder and a great partner. And then Phil Green, in partnership with Trevor and Morris at Alceon. Phil is the best risk thinker and structurer and creative investor I've ever come across. And I've learnt and continue to learn an immense amount from him in how to how to use structure to create solutions to problems and how to think about risk. And all of those in combination, I think, are the basis to my style of investing and how I think about partnership investing. But then, as you mentioned, I spent some time in the US working for 3G Capital's Restaurant Brands International, which are iconic for creating long-term businesses that grow for a very long period of time. They have a number of tenets that they use to operate that really drive an ownership mentality within the business, strong alignment, and meritocratic behaviors. And that comes in the way they remunerate. They have a structure called managed by objectives. So the way they remunerate, their ability to control cost in zero-based budgeting, their thought around long-term mindset and long-term ownership really drives the way that they operate the business on the day-to-day. There are so many things within that business that experience that I learned and I've taken into and try and bring into Australia and into the companies that we invest in and into our private equity business. So within our private equity business, every team member is an owner of our business. So they have some ownership shares of our business and they're driven by ultimate profit. And we've brought in as many people from 3G Capital as we can. So Rahil Gupta, who joined me as a managing director last year, actually worked with me in Miami at 3G Capital. We had the same role. We had that same training of 3G Capital's iconic ownership style investing. And so we drive as much of that into both our private equity business, but the portfolio companies that we own and partner with.
Well, look, there's a lot of, threads we want to unpack there, and we will throughout this conversation. But I think if we take a step back, Bryce and I are sort of new to the private equity world. You know, we've interviewed hundreds of public equities managers over the years, but it's certainly something we've become more interested in over time as we've sort of learnt more. And I think there's a few names there that we should put on our to interview list. We should say we have interviewed Mark Carnegie, so it will include a link to that in the show notes if people want to listen to that. But I guess I would love to be introduced more to Alceon because we're not, super familiar with what you guys have done. But as we've been researching for this interview, you've been around for 15 years. So maybe can you introduce us to Alceon, what you do, and how you think about investing?
Sure. I joined Alceon 5 years ago, but as you said, Alceon has a 15-year history. Alceon's a multi-strategy private investment partner. When I say multi-strategy, they do real estate in a very big way now, private equity, which is the business I run, special situations and credit. The business was founded 15 years ago on the back of the GFC, and folklore has it there was one deal that they did that returned 5 times money in about 18 months. And that was really that was really the genesis of
folklore.
You say folklore?
Yeah,
or is it?
Well, I wasn't there and I wasn't invested.
Okay.
But from what I understand, that's very much the case.
Jeez.
But the founders of Alceon each come from leading institutions within Australia, JP Morgan, Macquarie, etc., and brought that institutional thinking into a much more partnership-focused, flexible and transparent approach to the mid-market and to bespoke investing. Over the years, Alceon has invested $13 billion. It's got about $6 billion under management at the moment. So it's really grown and its success speaks for itself, but it's very much stayed true to being a partnership-style investor, investing on behalf of high net worth and individuals. That's now grown to institutions, and really being a bespoke, flexible solution and being well known for its ability to be coming up with creative solutions and be quite fast. David Gribble from Goldman Sachs, he was the head of alternative investing for Goldman Sachs in Australia, took over as CEO in January. And so the business is very much kind of on its evolution. But within private equity, that is a business that I came in 5 years ago and really laser focused on the lower mid-market within Australia and partnership style investing, which we'll talk about. You know, Alceon has been the partner of choice for so many companies and for so many investors over 15 years.
When researching for the interview, we saw that your team invests in all the deals that you do. Is that like common practice and in PE? And I guess how does it change the dynamic with the companies that you're investing in?
Yeah, I would say it's not common practice within PE. Our approach is alignment is everything. And that's not just with our staff and our team investing. It's across every part of the business. So I'll start within our management of portfolio companies. We have taken a lot of what I learned at 3G and we've created a remuneration and investment scheme for executives and leaders within the portfolio companies to be seriously remunerated on the upside. Like our goal and the best part of our day job is making those individuals really wealthy from success.
Nice.
And it really is a highlight of, it's one of those pinch me moments that happens in what we get to do. But it's broader than that. Our PE advisory board, so we've got an advisory board just for private equity that is filled with 3 private equity legends that have had multi-decade experience. They have the opportunity to invest in every deal we do. And then within Alceon, as you mentioned, we say from front desk to founder, everyone has the opportunity to invest in every deal that Alceon does. Within private equity, it's very important for me that our team does invest. And frankly, if someone doesn't want to invest, we really think about whether we're going to do that deal. I have personally invested, for me, a material amount of my money in every deal that we've done. And this all comes back to alignment. And when we do invest, by the way, we sit pari passu to investors. We pay fees in the exact same way. There's no special treatment. And the whole idea is alignment. It's alignment into our management team and partnerships with the portfolio companies, but then it's alignment with our investors. So we are owners. We're sitting side by side our investors. There's nothing that we would invest in, or there's nothing that we wouldn't invest in that we would suggest to our investors. And this is the driver of everything we do. Alignment it's a core thing that came from 3G Capital. It's a core part of Alceon. And as a result, we're standing in the shoes of our investors and we're standing side by side with our founders and our portfolio leaders. We're there together and we're facing the same direction.
Nice.
Love it.
So we want to, I guess, unpack private equity broadly, and you flagged there that you're mainly focused on the lower mid-market, and so we'll get into that specific and what that means and why you like it there. But let's start broadly. Private equity as an asset class has done incredibly well over the past, call it, couple of decades, outpaced public markets by, depending on what numbers you look at, a few percentage points a year to even more. Make the case for private equity in 2025.
I mean, you just started, but I'll finish. We'll tag team it. Yeah. There's 2 pillars that make it, I guess, impossible to deny why private equity is a better investment place. One is size, so just the pure scale of investment opportunities, and the other is results. So if you take size, 99% of Australian companies are private. 99. I mean, you actually don't realise that. The ASX has 2,000 companies. Then if you actually look at the listed markets, what's been happening over the last couple of years, the number of new companies coming to market is about half of the average. So there's a trend that you guys have talked about with other guests that companies are staying private for longer. There's more solutions in the private markets.
Public companies are being taken private. Yeah. It's all happening, yeah.
Yeah, so there's a trend there that means scale and size is better in the private market. Then you go to returns. And what's really interesting is over the last 20 years, the ASX 300 has produced about a 7% return and private equity has produced about a 13% return. So it's about double. Over the last 10 years, it's actually more. It's 8 to 17. And then actually, if you look at the mid-market, so if you're just in private equity, the mid-market of private equity has outperformed the large cap private equity space by about 25%. So the large cap average returns about 19 to 19.5%, and in the mid-market, it's about 24%. So it's size and scales.
Yeah.
Size and scale. And there's a whole variety of reasons for that, and we'll talk about it. But there's clearly lots of trends happening that are creating more solutions in the private market for capital. Continuation funds is a big one, and that's actually just creating more runway in the private world.
So what is it specifically about the mid-market that is appealing to you? What's the sweet spot? And I guess what valuation are you looking at in terms of companies?
Yeah, sure. So I'll just zoom up to Alceon. We call ourselves the most flexible capital on the street. And that's because of the way that we do invest and the type of capital that we bring into every deal. Specifically in the mid-market, we're targeting what we call the lower mid-market. So that's businesses with an enterprise value up to $150 million. Typically, that means an EBITDA of at the minimum 5, but more likely high single digits up to 20, 25 on the max, I'd say. And what we're doing is we're focused on partnership style deals. So I mentioned earlier the large cap buyouts. They're often buying 70+% of a company. And management have a management incentive plan, but there may not be any other founders left in that business. We're the opposite. We like to be the first institutional capital in there, and we typically like to be 50-50 or 60-40 with our founders, and we can be anywhere from 40-60, so a large minority, up to a small majority. What we're focused on is partnership style investing. So if we don't have a rock star partner on the other side who has built a business or is running a business for us to partner with, it's not likely going to be a deal that we'll consider. And we're focused on the lower mid-market because if you come back to size, the opportunity set is greater. And what you find within the supply of capital within our private equity competitors is most of them graduate out of the lower mid-market. As they raise bigger and bigger funds, they end up going into the kind of larger mid-market or buyout. And that's typically the trend. Our goal and our focus is we're here to stay on the lower mid-market. That's kind of our turf, and we want to be the dominant player in Australia there. But coming back to why we love the sector, demand supply, as I mentioned earlier, is better. There's just more companies and there's less capital because capital graduates out of it. We're business builders, not, we consider ourselves business builders, not financial engineers. So the financial engineering of private equity, is table stakes. Alceon is a founder-led investment firm. We're actually business builders. We get our hands dirty. We sit side by side. We have a playbook for how we drive growth. We're change agents. We're in the business. And that suits the mid-market. And then finally, what's really exciting about the lower mid-market is the exit opportunities are greater because, as I mentioned, those private equity firms that graduate out, they're looking to buy and they're buying off us. And then as well as that, you've got trade. You've got the IPO markets always there. So there is just a great opportunity set on exit.
Well, let's get to the private equity playbook that you mentioned earlier because, people often see the numbers up in lights. What did you say there? Mid-market private equity, 20 to 25% per year versus the long-term average of the ASX, high single digits, low double digits. Then people often think about what private equity does is buying these businesses and just capturing that growth. But that's not the case. It's often they'll buy the business and put a lot of work into, generating more growth. Yeah. And so we really, I guess, want to understand what that looks like, how you do it, and, perhaps how it is different to some of the more visible examples we see in public markets and how they're trying to grow. So let's start general, then get into some of the specific stuff. What does it mean to be a builder of Australian businesses?
The way to think about that is we're not just a money source. Investing is table stakes in private equity. That's not what we do. I mean, we put money into a company for sure. We are business builders. So let's talk about what that is. The way I have defined it to myself is we're change agents, typically. We come into a business and there's a variety of different things that we will drive change in that actually are what become the catalyst for growth. So some examples is we can be the change agent for succession. Often we'll be buying a business. One of the businesses we bought in August last year, which is in the defense sector, we bought 70% of the business. We bought it off the father who founded the company and the son's in the business. And we brought in some management around him. We're a change agent for succession. And as a result, we're a catalyst for growth with new management. We can be and we always are a change agent for digital transformation. So we're very, very focused on digital transformation within our portfolio companies. As you would know, with AI and everything that's going on right now and new systems and enterprise software solutions out there, there is so much opportunity to drive growth. But most of these mid-market companies just don't have the capacity to think about it or the expertise. And we now have developed a playbook around that. Just within Alceon, actually, there's 2 people at Alceon that are entirely focused on AI. We're ahead of the curve in this space. We have our own proprietary AI systems, obviously using existing language models, but we're driving agentic solutions into our portfolio companies that they just wouldn't have time to consider. And then finally, we're a change agent for capital management. So how they think about the capital stack in terms of debt and equity, M&A, bringing in inorganic growth through bolt-ons. In almost every portfolio company we have done at least one bolt-on. And most of these companies have identified those companies before. They know them. They just don't have the capacity and the expertise to actually go and do that. And so that's a huge driver of growth. And then unlocking the exit opportunities, which we will bring in an advisor from the very beginning and work with them on identifying that.
So Zac, how are you actually finding companies within the lower mid-market? Like you say you're a change agent. Does that mean you're like looking for companies that have something wrong with them and you can identify where you can come in? Or what's the process to actually you find your universe?
So I'll start by saying definitely not in terms of something wrong with them. Businesses that we invest in are great companies, or I'll say they're very good companies that we're hoping to transition to great companies. We're looking to make everlasting corporations out of fantastic mid-market companies. So it's absolutely not something wrong with them. Every company in the mid-market that is growing, that is in an industry that has a trend behind it, has a huge amount of what we call corporatization, which is all the things that we talked about in terms of our playbook that need to happen in order for them to capture that growth. And what we bring to them is the ability to do that faster, in a more sophisticated manner, with an existing playbook, with the people around them that can execute this very quickly. How do we find these companies? We've got a 3-pronged approach. So we work very, very closely with the advisors in the mid-market. There's a number in Australia. We work very closely with them, Alceon, Miles, a number of others, Molus, etc. We work very, very closely with all of the advisors. We have great relations, and we make sure that we're seeing things hopefully early and eventually first. But that's relationship building. And then separate to that, we've got 2 other prongs. We have within Alceon 1,000 high net worth investors that invest with us. That's a very deep network that we have the opportunity to build on and to utilize for 2 things. One, to be what we call river guides in portfolio companies. We bring in some specific people onto boards, but also to provide opportunities. So that's one that's quite unique to Alceon. And then the other is we have a thematic-based approach to direct origination. Twice a year, and this is something we continually evolve, and it's not perfect yet, and I think it's one of the hardest parts of our job, but we're getting better and better and better, and twice a year we run a thematic exercise to pick 3 or 4 longer term thematics that we're focused on, and we do that through a gamified process internally, and the output of that will be a couple of thematics, and I can talk about where we are on ours right now because we're in the middle of one right now. And within those thematics, we'll pick some subsectors, and then we actually go out and directly originate within that space. We door knock, we call, we build relations. Now, it's unlikely that those transpire to a deal instantly. It's not how it works. But those thematics are medium term. We're focused on multi-year thematics there, and we're getting very smart in a specific subsector. And what we find is over time, either when a deal becomes available in that space through an advisor, we're smarter, we've been there, we understand the network, we know the bolt-ons, we know who's good, and we know where the winners are. Or over time within some of those specific companies, when they're looking to come to market, we've built that relationship.
I mean, I'd love if you could flesh that out. Yeah. And if you can't share like the current one, like the last one you guys did and where it eventually led.
I absolutely can. I'll talk about where we are right now, and then when we talk about some of the portfolio companies we had, I'll link it back to where we were at that point in time. Right now, we're midway through our process, our internal thematic process. Every single person within our private equity firm had a few weeks to come with a thematic, with a research-based thematic. That's not a go to ChatGPT, press a few words and read it out. Like, it's quite a deep thinking exercise. And the output of that, we then force rank them and pick 3 that we're focused on. So for this session, which we're in the middle of now, we're focused, or the picks has been the energy transition space. So we're focused on the energy markets, and there's a number of subsectors that can come off that. So just think about products that serve the growth of the grid. That's one subsector within energy transition. The other is the rise of the regulatory burden for businesses. Jeez. So just a statistic off the top of my head, and this was my one, so I know it quite well, but there were 5,000 new regulations that came into the mid-market, or came into the SME and business compliance world over the last 3 years, and only 1,000 that were removed.
Wow.
So the growth of regulation is very, very serious, and that's putting a compliance burden on businesses. And once again, that can be expressed in multiple subsectors. There's a number of subsectors that we can look at within there. ESG compliance is one, cybersecurity is another. So there's a number of different subsectors that come off that, and we'll pick a few that we'll deep focus on. And then the final thematic that we chose for this next 6 months is the rise of the wealth inequality, and what that therefore leads to in terms of businesses. So it's kind of the barbell effect of businesses. Businesses at the upper luxury and businesses, favouring the low-end market, we feel are both going to grow very well. And so these are thematics that we're in the middle of this process. We'll deep dive and choose subsectors within that.
Nice. The rise of regulatory burden on mid-market companies is a reminder that investing doesn't always have to be sexy.
I would say if you look at our portfolio companies, and we'll talk about them, we focus on companies that are not sexy. Now, we find them sexy, but they're not venture capital-led tech kind of potential moonshots. These are regular, everyday Australian legend stories that you might not know about, but are producing real cash and growing really well and have amazing founders behind them.
Yeah.
But they're everyday businesses driving this economy. They're not moonshots that might strike and might not.
Yeah. You mentioned a couple of times amazing founders, and I'd love to dig in on that because it's something you're obviously looking for, but it's really a transferable exercise for whoever is investing in whatever part of the market, public, private, big, small. Like, great founders seems to be a really common thematic. So what are you looking for in a founder? What separates good from great?
Yeah, fantastic question. And I think you're right. It feels like a bit of a table stakes comment. It's like, I like smooth scotch, but every scotch says they're smooth. That's not the case for us. We are partnership style investors. So we're happy to be 50-50, which means we have to partner with someone on the other side of the table that we want to be in business with, or want to be, essentially in inverted commas married to for a number of years as we build a business together and sit side by side with. What really makes that, so building the mental model for us around what defines a great founder, first and foremost is doing what they say they're going to do. So, a founder that actually says, does what they say, delivers, separates the quality very quickly. 2 within founders is having an innate understanding of how to measure risk and how to grow within their business sector. So what you'll find in great founders that we work with that have built businesses that are amazing, they are often not conventionally trained, and they often have an innate ability to take risk and to lead a team of people that work with them, to follow them into that journey. They're kind of a couple of key characteristics that we're looking for in what makes a great founder. I mentioned, what I learned from Ruffy in the early part of this conversation. You've got to take every meeting. You've got to meet everyone. You've got to build your mental model. You've got to go through a number of repetitions to know, actually, just because that person in my first 3 meetings said all these things, I realize that they're not going to deliver. And here's why. And that's what we've built over decades of doing what we do. And frankly, it's the hardest. We don't always get it right. No one can always get that right. But our strike rate is decreasing significantly, and we're really focused on only partnering with the best.
So, Zac, we want to now drill into your portfolio and how it's actually structured. And we want to start with the structure of the fund itself. It's a fund of one versus commingling. What's the distinction here? Can you explain why you've sort of chosen this approach and what it means? Yeah,
fund of one style investing means that every investment sits in its own vehicle. It has its own investors brought into that specific corporate structure to invest in one asset, as opposed to other funds where it's typically a multi-asset fund. Now, the genesis of Alceon is fund of one investing. It's really what Phil, Trevor and Morris have done for years before that in their prior companies. And there's a number of reasons for it. But it's not only what Alceon does now. Alceon has evolved into many institutional funds as well and many multi-asset funds. Within private equity to date, we're only fund of one investing, but we are looking at hybrid solutions to evolve our business and evolve our capital opportunity over time. And many of our investors are asking us for hybrid solutions for a variety of reasons. But I will talk about what makes the fund of one structure unique and, in my opinion, attractive and beneficial to everyone. Firstly, within a fund of one style investing, there is no room to hide. There isn't.
Yeah.
You're forced to have 10 out of 10 discipline and investment thinking and approach for every investment. Whereas within a fund, if you've got a fund of 10 assets, you've got a portfolio, 3 do amazingly, 4 do average. If you want to just finish the fund, you might take an average investment just to deploy the rest of that capital. That, in our opinion, does not create pure alignment. It comes back to this alignment point. We have to have the utmost discipline and rigor for every investment because the spotlight is on every investment. For an investor, they get the opportunity to pick and choose. They get the opportunity, and remember, we've got 1,000, ultra high net worth investors, individuals and partners. These are often very successful business people in Australia. They're smart people. They want to ask questions. They want to understand it, and they want to get involved in certain assets. So they're attracted to our style of investing rather than giving money to a manager with a blind mandate to go and deploy in 10 businesses that they have no connection to. And then finally, for the vendor, so for the founder or the vendor, what's become really clear to me over the years of doing this is what they're attracted to is they are, in its purest sense, a partner with us. Rather than in a fund of many, they're actually a partner with the 9 other companies in their fund, and their fate in that situation is dictated by the success or failure of the other 9 companies. Whereas in ours, it's us and them, and we've got the flexibility within our partnership to do things like hold the asset longer, hold the asset shorter, those types of things that you can't do or you're not incentivized as a manager to do within a fund of many. So it's worked really, really well for us. We're one of the only managers that don't have any capital risk. So many fund of one style investors have to go and find the capital. We underwrite the capital within Alceon. We're large enough, there's no capital risk. So that's very unique. We'd be one of the few in the country that do that and can do that.
And just for people who want to understand what that means, like when you invest in a company,
Yeah, so when we do a deal with a company, we don't... Alceon will underwrite it.
Yeah.
So let's say it's a $35 million investment. We'll underwrite it, which means there's no risk that we can't get the capital.
Yeah.
And then we'll syndicate that and bring in the right investors that make sense. But ultimately that's on us. It's completely blind from the vendor's perspective. As I was mentioning though, we have had a lot of, requests for us to kind of evolve that as we've grown, and it's a bit of a watch this space, but we are looking at solutions that keep us within the DNA of a fund of one investor, but provide solutions for certain investors, wealth managers, institutions, etc., that want to invest with us, but potentially our timelines don't quite work with them in the way in which we do it today. And some of our larger family office investors who really invest in every deal we do and are just happy to commit to us as a manager. So we are working on hybrid solutions there, but the DNA of Alceon is creating these bespoke partnerships on a one-to-one basis, and we think it creates a better alignment and a better solution and a better result for everyone.
Yeah, nice. Love it. Well, let's dig into some of the actual companies in the portfolio. And as we were researching for this interview, it seemed that there was no sort of preferences around sectors. There was agriculture, engineering, healthcare, tech. It was pretty broad. So I guess tell us about some of the companies in the portfolio and what ties them together. Are there any common threads that run through them all?
Absolutely. The common thread between all of them is partnership and looking at opportunities through a hands-on business building mindset. In each of them, we've come to them with a thematic that drives our view of growth over the next few years. In all of them, there's a phenomenal partner and there's an ability to turbocharge growth through the value add playbook that we have. One of the investments we did last year was in a business called Boss Engineering. Boss Engineering is the kind of simplest way is the Apple of seeders and planters and advanced manufacturing for farmers.
Nice.
And the thematic we were looking at that time was a thematic called supporting the grower. At the time, we had identified that, through the geopolitical movements, things like global food insecurity, onshoring supply chain, Australia as a leader in commodity export were part of our thinking. And when we looked at supporting the grower as a trend, we did not want to be in direct commodity risk style business models. We wanted to be in the type of picks and shovels style business. As a result, we were looking at a variety of different companies at the time, and we made it very well known to the market that we were looking at this space. And then someone from Miles Advisory brought Boss Engineering to us as an early introduction. And I'll do a shout out to Tim Miles, because I think I just would like to mention at this stage what he did for the mid-market in Australia and his tragic loss. At the time, this was a year ago, we were introduced to Boss. The story immediately struck us as phenomenal. 3 founders in northwestern New South Wales were previously working at an agricultural equipment business and left it about 15 years ago because that business would not adopt robotic manufacturing. These guys were really ahead of their time, and they started Boss Engineering with a view that everything had to be robotic first. And what they created is the premium product for mission critical kit for farmers. So that's seeders, planters. They've now moved into air carts, and recently under our partnership, we bought a business that does sprayers. And so these are all mission critical for farmers.
And just to get my head around it, when you say robotic, do you mean like automated robots, no farmer driving the tractor?
No, I mean in how they manufacture.
Oh, right.
So
okay.
the actual, so they've got a 32,000 square metre facility in Inverell. It's phenomenally impressive. This is an Australian legendary story. This will be the kind of Breville of this industry. It will, and it already is going global. They have adopted robotic manufacturing as a style of, or as a future of manufacturing in Australia very, very early, and they're leaders.
And just define what robotic manufacturing is.
To be very specific, they've got nearly 40 robots within their manufacturing facility doing manufacturing, for example, robotic welders.
Wow.
They're leaders in actually building and programming these robots, and they're continually optimizing. So they've got a very, very strong engineering and internal engineering thought process as to how they optimize their manufacturing.
Epic.
Wow.
Yeah, it's amazing.
When we do the follow-up interview, let's do it at their facility.
We absolutely should. And last year we took 30 investors to their facility for that reason, and people had a great time. But when I say they're the Apple of this industry, they actually are. They create the best product. It's the most flexible and adaptable to Australian conditions. It's the most easy to use for farmers. They've got the best aftercare support. And as a result, they've got 40% market share of the large scale farms within Eastern Australia. And the opportunity was to grow that into Western Australia and take it global.
Seems like you got them for a steal.
Well, I mean, the challenge with agricultural investing, and this is, comes to our point of how we think about things a little bit differently. Private equity has typically not liked agricultural investing because of its cyclicality and its seasonality. And it is. It is cyclical, and it does have seasonality. We created a solution for the founders. It was a structured solution. So we have a downside protection mechanism, and we actually try achieve some form of downside protection in every investment we do. And in exchange for that, within this opportunity, there's an upside opportunity for founders if they overachieve our base case. That's a structured solution that we were able to do, and it comes to this kind of creative, bespoke approach and this business-led or business-forward approach to investing that made sense to them. When Miles brought this opportunity to us, we built the relationship well ahead of them running a process. We went up to their site a number of times, and then they ran a process. And they ran a process because one of the global manufacturing corporations had tried to buy them 3 times. And so they ran a process on the back of that, and they ended up partnering with private equity instead because they weren't ready to, hang up their boots or hang up their welding, their welders, so to speak. And they were looking to partner with someone to corporatize the business for the next stage of growth, which is which is focused on increasing the products that we have on offer. So I mentioned we've gone into sprayers, but then also geographic expansion and then international expansion. So we're focused on that. It's been hugely successful. We've been in it for a year. We've done so much, within our 180-day plan in terms of strengthening the bench around management. We've put in a new CEO, new CFO, a number of people within the senior leadership team. We've optimized the system. So we're just finishing a new CRM. There'll be an ERP, new website, new marketing program, all that type of stuff. We're putting in our kind of AI digital program into their business. And then finally, the third pillar of our growth playbook is capital management. So we've done 2 bolt-ons within that business within a year, and we've set that business up really, really well for the next phase of growth. And that is a direct 50-50 partnership with those 3 founders. And it's a phenomenal partnership. I'm heading up there next week, and I love my board meetings, up there. It's really great.
Love that, Zac. I think a real example there of where you say you're builders in practice. Are there any other sort of portfolio companies that demonstrate that or come to mind?
Absolutely. I'll talk about Efex, which is a managed IT business that we partnered with, again, a 50-50 partnership in 2021. Efex now is the largest managed IT and business solution provider for the SME market within Australia. It has 7,000 clients within Australia. It's focused on not only the major cities, but also the regional hubs, which very few people are. And it's the only provider that has a network of regional hubs. At the time, one of our thematics was business solutions and the rise of services required for businesses. And within that, we were looking at managed IT. We participated in 2 other processes for other managed IT providers. We ultimately chose not to proceed with them for a variety of reasons. And then we were introduced to Nick Sheehan. Nick Sheehan is the founder of Efex, another absolute rock star. The guy has an incredible amount of energy, but more than that, his leadership capability and what he's been able to build is just truly remarkable. Another Australian legendary story. We met in 2021. He was about to run a process. It was COVID. He happened to live close to me, and instead of doing a number of Zoom calls, I said, let's go for walks. And we ended up doing a variety of walks around Bondi and Rushcutters together, and we built a relationship, and I ultimately convinced him not to run a process and to do a deal with us. And we bought 50% of that business. We partnered with Nick. Since then, it's been 3.5 years. We've tripled the business. We've bought 6 companies into that business. We've now become the largest, as I mentioned earlier, SME provider of business solutions. They primarily do managed IT and document solutions and cyber for businesses up to 100 people. Within that, we renovated the systems and processes. We ran our playbook through that business in partnership with Nick, and the results have spoken for itself. The thematic was correct, so that thematic continues to grow. And what we've found is focusing on partnerships. So if you think about how Nick operates that business, the growth that he can deliver is just phenomenal, and we've been really proud of what's been achieved in that business to date.
Nice.
As a founder of a business, well, co-founder of a business that certainly doesn't have 5 to 25 million in EBITDA, but one day hopes to, just hearing you talk about the way that you come in and just like supercharge these founders, it's like all of a sudden you have access to capital and access to these systems.
Bolting
it's like,
on businesses.
I'm pretty jealous. It's like, if I could think of a number of companies I'd love to bolt onto Equity Mates, we just don't have the requisite EBITDA at this stage.
There, yeah.
I think what you find is, well, firstly, one day you'll absolutely get there, and I have no doubt that next time we talk, you guys will have grown successfully. But what you'll find is most successful founders like yourself are thinking that way. They just don't have the time and the capability and the resource around them to execute. And you get to a point, as did Nick Sheehan at that time, where it was as far as he could take it solo, and he needed some more sophisticated thinking around the table in setting strategy and delivering on key growth pillars in order to achieve that. And that's it was a pure partnership. The first thing we did is we built the 3-year strategy together.
Yeah.
Nice.
Well, Zac, to close it out, for investors listening, I guess, how should they start thinking about PE? I think a lot of people are already thinking about it, but how should they think about it, adding it to their portfolio? And in particular, with the range of managers out there, how should they start assessing and distinguishing between the different options?
I think the first thing for an investor to think about is, do they want to invest with a manager that's essentially blind to them. So it's kind of a little bit more faceless. They give them the money and the manager goes off and does what they do, and eventually they return some capital, hopefully. Or do they want to be closer to the manager? And so we're an organization with a face. Every one of our investors and our partners can call me or any of my team at any point. And, do they want to actually be investing in the highest growth opportunity part of the market, which is the lower mid-market, with an organization that has, institutional rigor and does what they say they're going to do, but, actually they have some ability to see the investments before they're made and think about those portfolio companies before they decide to allocate. The other thing to consider is just the core tenets, which is, does the manager do what they say they're going to do? What does the team look like? Has that team, is it one rainmaker and a sweatshop, or is it a real team with a core culture and a philosophy of continuous improvement and actual processes that, they have built over years that they can drive growth in portfolio companies with? And then finally, I would say, do they want a manager that has, a face to them? They want a manager that they can pick up the phone and talk to. That helps kind of your listeners think through what type of private equity investor do they want. Private equity is growing. We talked about that. There's a number of different ways to get into it, but we are business builders as well as, investors. We're both. And many of your listeners, from my understanding, come from businesses and think about business the same way. The same way we do.
Well, Zac, thank you so much. That does bring us to the end of our conversation today. It's been awesome. We appreciate you sharing your time, and always a lot to learn when it comes to PE. And as you said, we'll certainly be watching this space. So thank you so much.
Thank you, guys. Thanks for having me.
Thanks, Zac.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful. Equity.